I'm Andy Roth. My co-speaker, Bill Miller, is one of our actuaries. So he's going to hand out the handouts for us. Just a very brief infomercial about our firm. We're a law firm based out of White Plains. We also have an office in Melville. And we do three things and three things only, so we're a true boutique. Employee benefits, and the topic of today's discussion will be our qualified retirement plans for you guys. We currently have in total 12 attorneys. 5 of them are ERISA attorneys, which means basically pension lawyers, including myself. 6 enrolled actuaries. Bill is actually our senior most actuary, and we have 20 plan administrators, which means we also do TPA work, which is administration. So we not only design plans geared for the business owner. I know many of you, own the golf shops at your clubs, so in effect you're a business owner. And normally what we do is we maximize the contributions for the business owner. It doesn't come as a shock to you. Minimize the cost for the staff as well, and create a lot of flexibility along the way. We also have a trust and estates practice and a corporate practice. So that's so much for the infomercial. We're not going to talk about all of this because all of this really doesn't apply to you guys. I'm assuming that the bulk of you are W-2 employees for the club. Your club hopefully has a 401k that you may or may not participate in. We'll go over the limits there. And some of you also own the concessions, the golf shops within your clubs, and some may not have employees that you hire to manage the club. It may just be you. Some of you may have employees. So we'll try to touch on all of this stuff for you. And since you're a relatively small group today, please feel free, raise your hand. There's no silly question that you can ask. So we're going to talk about profit sharing plans. We're going to talk about 401k plans. We're going to talk about Roth 401k plans, and we'll just touch on defined benefit plans. I don't know really if that is going to be relevant to you guys, but we'll sort of touch on it a little bit. So by way of background, and I promise I'm not going to get very technical with you guys, but by way of background, a qualified plan is a great way to help the business owner meet their business goals as well as their retirement goals. And by business goals, the best possible business goal you can have as a business owner, and you could be a business owner with employees, you could be a business owner without employees, but the best possible goal you can have really is to get the largest possible tax deduction for yourself during your working lifetime, thereby reducing the taxes that you pay currently. So as Paul knows, as an accountant, classic tax strategy is to get the largest possible tax deductions during your working lifetime, and then defer the recognition of tax for as long as possible down the road. And that's the typical classic tax strategy that accountants implement, the tax lawyers implement, the actuaries implement, and the investment folks implement as well. By retirement goals, you'll see a slide momentarily which will show you why saving in a qualified plan, whether it's a profit sharing plan, 401k plan, defined benefit plan, it's the best way to save for retirement. And you'll see a very powerful slide in a second. And as I said, without belaboring it, what we typically do at Danziger and Markov is to maximize the contributions for the people in this room and minimize the cost if you have any staff associated with your business. Okay, everyone in this room should be very happy, although I do see a lot of very young people, so you may not care as much as Bill and I do, but we're very happy about this slide. People are living a lot longer. Back in 1900, I don't think any of these speakers probably would be here, would be long gone, but we're all living a lot longer, I don't have to tell you, and you're all athletes, so that's a good thing, so you're certainly going to live a long time. We're living into our 70s, 80s, and 90s, so that's pretty spectacular. I'm actually proud to say that my maternal grandmother lived until she was 102 years old. But then again, she didn't have to live with my ex-wife. So you never know, hopefully I'll be around for quite some time. But the bottom line is, so we're living a lot longer, wonderful, spectacular, I love it. I made your day, made my day. That's the good news. The bad news is the last thing we want to do is run out of money in retirement. We don't want to do that. The rule of thumb is you need 70 to 80% of your pre-retirement income to live comfortably in retirement. I happen to think you probably need closer to 100%. A study came out fairly recently which said, you ready for this? You need 126% of your pre-retirement income to live comfortably in retirement. That's crazy. So that means, and I'm not the actuary, so I'll use a nice round number, say $100,000. That means you need $126,000 to live comfortably in retirement after you've been making in your lifetime $100,000 a year. That's crazy. So whether it's 70%, 80%, 100% or more, the best way to save is with a plan. Now I'm going to make a couple of assumptions, and this is the slide I was alluding to before. A couple of assumptions. First assumption is you're a better investor than I am. So we're going to assume a 6% rate of return. And I know the stock market today is a little volatile, but let's assume a 6% rate of return over a period of years. And let's assume, and we just threw this out there, and even if it's a lower tax rate, and you may be in a lower tax rate, the numbers are still going to be quite dramatic, as you'll see. So let's just assume these. It makes my life very simple with nice round numbers. Let's say you have $53,000 of income, and you certainly have that. If you don't have a plan, and let's say you're in the 50% tax bracket, and certainly people who live in New York City are in the 50% tax bracket, they'll have $26,500 to invest because you're paying half on taxes. After 30 years down the road, saving that money, you'll have $1.2, $1.3 million at the end of that period. Not bad, that's good. And as Paul would say, this is, this has already been taxed, so you don't have to worry about paying tax on it. However, if you have a qualified plan, and a qualified plan, for those of you who don't know, a qualified plan is a plan where you put money, your income, into the plan as a contribution, and you don't pay tax on that contribution. So it reduces your taxes, so you don't have to pay tax currently. So if you take that full $53,000, because you're not paying tax on the 53, it goes into the plan. At the end of that 30-year period, you'll have roughly $4.2 million in that plan. So that's 3.5 times what you'd have if you didn't have a qualified plan. So that is an extraordinary number and pretty spectacular. Now Paul, who's the accountant, is going to raise his hand and say, well, wait a minute, Andy, this amount has not been taxed yet, and he'd be absolutely correct. But what happens to that $4.2 million? That $4.2 million doesn't come out of your plan in one check, where you take it out of your financial institution and pay 50% or 40% or 30% or whatever you're paying. You don't take the full amount out. Normally what happens is, and a lot of you, once again, hopefully have money socked away in a 401k plan, the money would wind up going into a rollover IRA and sits in an IRA, which is also a tax deferred solution, and you only have to start taking the money out the April 1st following the year you hit 70.5, and then that's only a minimal amount. It's de minimis. It's like of the total amount, that first distribution is something like 3.65%. So if you have the 4.2 million, you only have to take out, by law, $150,000, and the balance can stay in the plan infinitum, and then you take out a little bit every year. So the goal, once again, is to get the largest possible tax deductions, thereby saving on taxes now, and then defer the recognition of income for as long as possible down the road. I'm not going to go over all of these different limits and bore you, because a lot of them don't even apply to you. But once again, as we mentioned before, in a profit-sharing 401k plan, and I don't know if your concession has it or doesn't have it, but the limit for an individual generally is $53,000. Now, if you participate in your club's 401k plan, you probably know what the limits are. The limits, if you're under 50, and I see the bulk of you are certainly under 50, that's $18,000. And it was $18,000 last year as well. So in 15 and 16, $18,000 is the limit. If you're lucky enough to be over 50, you get something called a catch-up contribution of $6,000. You can put away as much as $24,000 in your club's 401k plan. And if your club doesn't have a 401k plan and you have a concession, you could actually set up something called a Unit K, which would be both a profit-sharing plan and a 401k plan combined, so you could utilize this benefit. Another benefit of 401k, and once again, I don't know if your clubs have it or don't, some may not, is a Roth feature. With the regular 401k, you can put in your 18,000 or 10,000, whatever number you want to put away, and you save on taxes then and there. With a Roth, the money goes in, and you pay tax on, let's say you put away 10, you pay tax on the full 10, but the money grows tax-free versus tax-deferred. Remember what I said before? Typically money grows, and then at some point, 70 and a half, you have to start taking out. You pay tax on the money then. If you have a Roth account, you never pay tax on that money. The money just comes out tax-free. And if you're married and your spouse has been good to you and you kick the bucket and it goes to your spouse never has to take the money out. So it's not subject to these minimum required distributions that I mentioned previously. So there are two types of plans, your profit sharing 401k variety and your defined benefit variety. Defined benefit typically gets you a larger contribution, but if you're younger, that would not be the case. So, more often than not, we just recommend maybe a profit sharing or a profit sharing 401k for the younger folks. Now, also, and as I said, I'm sort of shooting blind here, but if any of you have a profit sharing plan in your concession, or if your club has a profit sharing plan and a 401k is part of a profit sharing plan, whether they use the profit sharing feature or not, every defined contribution plan needs to be restated by April 30th of 2016. So just keep that in mind. As I said, if any of you really have one, the plan has to be redone. The old plan goes into the garbage, and the new plan has to be redone to comply with applicable law by April 30th of 2016. Okay, so now let's just talk. There are three formulas in a profit sharing plan. The first formula is something called non-integrated or comp to comp, which basically means everyone has to get the same percentage across the board. And we're assuming we know, obviously you're not necessarily at 265, but the gist of it is both the owner and let's say you have one employee, they have to get the same percentage that you get. It sort of is not a cost-effective formula. If let's say you do have a one or two or three employees, your employees have to get the same percentage that you get, and that is sort of silly unless your name is Karl Marx or Mother Teresa. Most small business owners do not like to do this. Now, a lot of people don't realize it, and I'm going to let Bill speak briefly about SEPs. If any of you have a SEP in your concession and you have employees in your concession, that probably is not the best plan for you. You're probably better off implementing potentially a profit sharing plan if you do have employees in your concession. So Bill, why don't you talk just very briefly about the benefits of a SEP versus a qualified.
All right, so specifically, I'm going to go to this line over here, the part-time seasonal exclusion. Basically, under a SEP, if any of you do sponsor a SEP, the SEP has to include any employee who rendered during the 3 out of the 5 prior years any service whatsoever, and during the current year earns at least $600. So let me give you an example. If let's say you're anticipating making a SEP contribution for 2015, 3 years before that is 2012. So if let's say you have an employee who worked 1 hour for you in 2012, 1 hour for you in 2013, and 1 hour in 2014, and that employee earned at least $600 in 2015, that employee must receive a SEP contribution based upon whatever contribution rate you as the owner are receiving. In contrast, if let's say you do have these kind of part-time employees, you can adopt a profit-sharing plan. A profit-sharing plan can impose a 1,000 hour a year rule to get into the plan and to accrue a benefit under the plan. So if let's say you do have a lot of these part-time employees who work way fewer than 1,000 hours for you on an annual basis, then adopting a qualified plan, such as a profit-sharing plan, would eliminate all those employees from your plan so that you yourselves could maintain and receive a full contribution without putting any money into into the SEP as you would if you had a SEP.
Now, also, a benefit of having a plan would be, in a qualified plan, you could actually, not that we recommend it, but you could take loans out of a qualified plan, up to $50,000. You can't take loans out of a SEP. A SEP is more or less a glorified IRA, and with an IRA, there are more limitations. Also, you could buy insurance through a qualified plan. You can't buy insurance with a SEP because that's illegal as well. Okay, I think I'm going to skip over this slide, and this slide certainly. Yeah, I'm really not going to go over this really too much because your club probably has 401k, and they probably have some of these features, if not all of these features. But what I'd like to do is maybe move to the Roth once again. Oh, one thing. By the way, if any of you are married, you could actually sometimes double up on your contributions. If you put your spouse on the payroll of your concession, you could, possibly double what you're able to put away potentially. So that's another wrinkle or another benefit to having a qualified plan. Okay, Roth, once again, whether you have it at your club or not, you could always certainly have it in your concession, adding a 401k feature if you don't have it in your club. By the way, a 401k is an individual limit, which means that you can't, if you have a 401k in your plan, then it doesn't make sense to have a 401k in your concession because you can't put away 2 18s, you can only put away 1 18. Similarly with a Roth, if you wanted to, you could do half Roth, half regular 401k. So the limit, as we know, is generally speaking for the people in the room, 18,000. You can put away 9 as a regular 401k, and if you want some tax-free income down the road, you can put away the other 9 or 1/3, 2/3, in a Roth if you'd like. So once again, no deduction for the money going in, but when the money does come out, and it actually never has to come out, it comes out on a tax-free basis. Also, the other benefit of a Roth is a lot of our clients, and you can see the limits here, the income limits. A lot of our clients don't even qualify. They love to do a Roth IRA. They can't even do a Roth IRA, okay? But anyone can do a Roth 401k if it's in their plan. So Donald Trump can do it. Warren Buffett can do it. Anyone can do it. It doesn't matter how much they make as long as it's in the plan. But those people couldn't do a Roth IRA. So once again, if your club has a Roth, it's something maybe you should consider. If your club doesn't have a 401k at all, certainly it's something that you should consider implementing for yourself, utilizing this Unit-K concept, having a profit sharing as well as a 401k as part of your concession. Because once again, it eliminates, as Bill mentioned, any part-time people. So if you have young people coming and going, part-timers, generally speaking, if they're around for a period of 3 years, you have to include them even if they put in, are making just a couple of pennies. But with a qualified plan, you don't have to do that.
Can you go back to that slide for 1 second?
Which one?
The prior slide. So that income restriction, you have to, like it says, contributor restrictions. For a single, you have to have your income between 117
no. If you're sitting, I'm sorry, I didn't explain it well. If you're single, it shows that there's a phase out. So between $117,000 and $132,000 and you're single, the ability to do the Roth phases out. So up until $117,000, you could do a full Roth IRA contribution of $5,500. And then it phases out gradually between 117 and 132. But once you hit 132, then you're not able to do it at all. So if you have income in that range or beyond that through your concession, or combined, obviously, with the club, then you're not able to do a Roth. So that would be the benefit of having a Roth 401k. with your club or outside of your club if they don't have a 401k. And once again, the Roth 401k does not have any income restrictions. Now, when does it make sense? Yes?
Should we be taking advantage of the Roth IRA while we fit into that bracket?
Absolutely, absolutely.
The IRA, what is it? Like,
Yeah, I mean,
that's
I
where
think.
I'm at, right? Like, I do the IRA version, not the 401k.
Yeah, I mean, I think a Roth, I mean, and you sort of, hitting on my next slide here. A lot of things in life are not black or white, but the normal rule of thumb is, and we usually punt to guys like Paul to determine whether the client is an appropriate candidate for doing a Roth or not. But certainly if you're a young, low-paid person, you're not losing the tax deduction by doing a Roth because you're in lower taxes and the money's going to grow for many, many years on a tax-free basis. So I would say if you're young, 100% do a Roth. If you look like this guy here, I'm not so sure you should do a Roth, kid. I'm not so sure you should do a Roth if you're somewhat older. But I mean, Bill might say, you should do a Roth under any circumstance, potentially. But my view is that, if you're an older employee, you make a lot of money, and you're not gonna, your lifespan is not going to be all that long. Maybe it makes sense to take the deduction and run. I wanted Bill, and I know we're running out of time, and I'm going to turn the baton over to these guys. But I wanted Bill to talk about one element which is sort of like a relatively new strategy. So why don't you talk about the backdoor Roth very, very briefly?
Okay. All right. The Roth contributions are really an interesting kind of item. Depending upon, go back to the income limitations. Okay. Let's assume you're married, and let's say your income falls below the 184, 194. However, you're an active participant in a 401k plan. What probably that means is that you're not eligible to do a deductible IRA contribution. In that case, since the income would be less than 184, definitely by all means, in order to take advantage of whatever is available for you, you should definitely do the Roth IRA because you're not otherwise permitted to do a deductible IRA depending upon what your income is. However, there's another strategy. Let's assume you're fully taking advantage of the 401k, and you want to, and you're not eligible for deductible IRA contribution, and you're not eligible for a Roth contribution. There is a strategy called the backdoor Roth strategy where you could take advantage of depositing the $5,500 IRA. And what that is if, let's say, you don't have any traditional IRAs in your name. If you don't have any traditional IRAs in your name, what you would do is deposit the $5,500 into a traditional IRA on a non-deductible basis because you're not eligible for the deduction because of the 401k and potentially your income. And then once the money hits the traditional IRA, you would then convert that IRA into a Roth. Anyone could do a conversion at this point in time. There's no income limitation. The reason why this is a relatively new strategy is prior to 2010, there was an income limitation of $100,000 in order to do a conversion. After 2010, there's no longer an income limitation. So again, what the strategy would be is depositing a non-deductible IRA into an IRA, and then you then convert that IRA into a Roth. And basically what you're doing is taking advantage of the rules so that this $5,500 would then grow tax-free.
Do you guys recommend any kind of delay between that conversion, or can you go ahead and make that conversion immediately?
Me personally,
Yeah.
I deposit it, and the day after, as soon as the check it clears, I basically convert it into a Roth.
What happens the following year when you want to deposit again? You have to make a new IRA? Or you
Well, no,
cannot deposit into that Roth?
you could have an IRA open,
Okay.
and then you put the money into that IRA that's open. You're not closing it. It could be left open, and then you just transfer that IRA into a Roth after the initial deposit is made. And so, I mean, now the big thing here is that you can't have, in order to use that strategy, you can't have any traditional IRAs in your name. If you do, there's also another strategy. If you're participating in the club's 401k plan and that 401k plan allows for rollovers, IRA rollovers. What you could do is roll over the IRA, the traditional IRA that you have in your name, roll that over into the club's 401k plan. That way, you no longer have any IRAs in your name, and then you can utilize the strategy. So it's something that I personally have been doing since, let's say, 2010, and if it applies to you, in order to take advantage of the rules, I strongly suggest taking advantage of it.
And he's not in jail yet, so that's a good thing.
But just to clarify, you said you don't have any traditional IRAs in your name. You would have to have it in your name, but just with no money in it, correct?
Yeah, that's okay.
Is that what you mean?
The reason why, let me tell you why. What happens is that when you do the non-deductible IRA, you have basis in the IRA. And there's rules in, let's say, recognizing the basis. And generally what the rule is that you recognize it on a pro rata basis of your total IRA. So let me give you an example. Let's assume you have $95,000 in your traditional IRA. You dump in $5,000 as a non-deductible IRA. So now you have a total of $100,000. Many people think, oh, I put the $5,000 into a separate little account and then move that $5,000 into my Roth. It doesn't work that way. The way it would work in that case is that $5,000 represents 5% of your full IRA. When you move the $5,000 that you think that's all fully non-deductible into the Roth, basically, because it's this proration, 5% of the $5,000 or $250 is actually recovery of your basis, which means the $4,750 would be deemed to be a taxable distribution to you when you do the Roth. So in order to clean up all your outside IRAs, if the club allows you to roll that money into the club's 401k, that way you can get rid of all your traditional IRAs so that the $5,000 that you put into the traditional IRA can be moved directly into the Roth.
Now you can see why Bill is such a big hit at cocktail parties. Okay, so I think we're coming close to the end. New comp, I'm not going to really bore you with it, but if any of you are suitable candidates for having a plan and you do have employees that are full-time people working for you, so they can't be excluded, the way to go would be utilizing this last formula, which is something called new comparability, because it skews the benefits in favor of the owners and minimizes the cost for your full-time staff people. Certainly the way to go, state-of-the-art for small businesses typically. Okay. Let's skip all of this stuff. Oh, I'm just going to show you one thing. You know, by having new comparability, and if you have the right demographics, you know, normally, as we mentioned before, if the owner is going to maximize, then they have to get a 20% contribution. If you have a plain vanilla plan, you've got to give everyone you're employed 20% who's full-time. If you have a SEP, you even have to give your part-time people, you know, the young kids who work for you, 20%. On the other hand, if you have new comparability, without even a 401k element, the staff costs can go down to as low as 5%. You've lopped off 75% of your staff cost. So that's why small businesses love this concept of new comparability. You know, I'm going to go over this. This really doesn't apply to you because, you know, you're not multiple owners or whatever, but let's say there's even one owner with new comp and like a couple of other features. So but I want to show you what the punchline was, and this is the true story. So each of the owners got the maximum 59 because they're over 50, because they get 53 plus a 6% catch-up. They wind up getting $236,000 as a group, 4 times 59,000, and they had a bunch of young staff folks ranging from 25 to 35, all, as you can see, relatively low paid. So in order to get them the maximum, you had to give a certain minimum amount to the staff. And Bill's job with his team is to make that crumb the smallest possible crumb. So at the end of the day, in order to get these people their $236,000, and they were certainly in the highest tax bracket, so they were saving, you know, say $115,000 in taxes, it cost them $4,500. They had to give $4,500 as a contribution. They got 98% of the total pie. They had to give a measly $4,500 to the staff. And just to show you the mentality of the small business owners we deal with, one of the business owners said, "Does it have to be that much?" the 4,500. I almost fell off my seat, I couldn't believe it. But that's the mentality of the small business owner who wants to obviously maximize their own contributions and minimize the cost for the staff. Since I didn't go over any of that, I skipped very quickly. Now, just very briefly, for a couple of minutes, for those of you who may be somewhat older than the others, a defined benefit plan, which is an actuarially driven plan, which is something that, you know, Bill needs to work on, the numbers can be quite dramatic. There are limits on what you can put away in a profit sharing plan. You can't put away more than either 20 or 25% of your compensation. However, with a defined benefit plan, there are many benefits to getting older, I should tell you, and I speak from firsthand knowledge. However, with a defined benefit plan, there are benefits to getting older, because as you get older, the more money you can put away in these plans. So, because your window to retirement is closer, so you're able to scrunch it and put away a lot more money thanks to Bill Miller. And Bill has gotten huge numbers of contributions for our clients, beyond belief. But sometimes a defined benefit plan may make sense for you if you're somewhat older and you don't have staff, or you have part-time staff or very young staff, then maybe a defined benefit plan would potentially work for you. But it certainly works well when you have 1099 income, when you're independent from your employer, and also if you ever have any of, you know, supplemental income. Obviously, you're not going to have director's fees or speaking engagement fees or that kind of stuff. But if you ever, you know, wind up getting 1099s for, which would be earned income subject to self-employment tax, a defined benefit plan may be the way to go, and we could always analyze that for you. But the numbers, as you see, are insane numbers, so I'm not going to belabor it. And I think we're going to be pretty much done here. Cash balance is not going to apply. And lastly, you know, we offer this up certainly as a courtesy to you guys. If you ever need us to review what you currently have, if you do have anything for your shop, or if you have any questions regarding what you're doing at the club itself with that plan, we could always do an analysis for you on a complimentary basis and meet with you, and maybe you can give Bill some free golf tips and we'll barter it. But with that said, we want to thank you so much. We're going to have to scoot. We have to now go into the city and bore another group of people. And we appreciate your time and attention. Thank you.